Hello and welcome to this video on monetary policy, in particular the use of interest rates. So previously we were looking at macroeconomic objectives, what the government wants to achieve within the economy. For example, low levels of inflation, which is the primary target in the UK. Now we're going to turn our attention towards policies. What are the things that the government can control in order to try and meet these objectives? And today we're going to focus in particular on monetary policy and interest rates. So let's start off with looking at what is monetary policy. Monetary policy, well, if we look at the word itself, policy over money, monetary issues. Monetary policy involves changes in interest rates, the supply of money and credit in the economy, and exchange rates to try and influence the economy. So we're talking about these kind of things. The central bank within the economy has within its power the ability to change interest rates in the economy, change currency values in the economy, the amount of money in the economy, and as a result, influence the objectives, influence economic level of economic activity or the economic performance of the economy. So in this video, we're going to look at what is meant by monetary policy. We've kind of already covered that one. Look at or be in a position to be able to describe how interest rates are used in the UK. And then finally evaluate the use of interest rates. So let's start to think about what an interest rate is. If you have savings, then interest rates probably affect you. Interest rates are most commonly associated with banks, and the role of a bank is to connect savers, people who want their money to grow, with borrowers, people who want to borrow money to set up a business or spend. So savers will take the money that they've earned and deposit it, give it to a bank. A bank in turn will then take that money and lend it out in the form of loans to borrowers. A bank will charge a borrower interest on top of repaying the loan to make a profit. And to reward the savers for giving the bank their money, the bank will then credit the savers with an interest payment that increases their savings. And the key for a bank is to make sure that the interest that they're receiving from borrowers is greater than the interest they're giving to savers, that they manage the timings of the withdrawals and the repayments and to make a profit. So if you have money in the bank, you are a saver, you will earn a rate of interest on top of your savings every year. If you are a borrower, you will be asked to pay back what you borrowed plus a percentage, and that is the interest rate. So an interest rate is the cost of borrowing or the reward for saving. Another way of thinking about it is it's the price of money. If you want to get your hands on some money, you could borrow it from the bank, but the price you would have to pay on top is the rate of interest. And lenders will often offer different rates of interest depending on how risky they feel you are. The riskier they consider you to be, the higher the rate of interest they're going to ask for to compensate them for taking the risk and lending you the money. Now, in the UK, this institution here is responsible for determining or influencing the level or the rate of interest in the economy. This is the Bank of England, and they control interest rates in the UK and they regulate the financial industry. Now, they have a very special role as a bank. They are not a normal bank that you or I would bank with, like NatWest or HSBC. They are what's known as the bankers' bank. So they are who the banks themselves go to borrow money. They are also responsible for regulating the financial industry, making sure that the financial industry, so all the banks, are behaving properly and are functioning well and with the economy's best interests. So whilst they're not part of the government, they're separate from the government. They are an independent organization that are part of the state, so they're not a normal profit-making business. Now, the Bank of England are responsible for setting the base rate of interest. That's the most important interest rate in the economy. It's the one that banks use to base their interest rates on. And if we look at this chart, we can see over time how that has changed. Rates of interest back in the 70s and 80s were up as high as between 10 to 15%, which was, if you were a saver, was great news. If a borrower, not so much. More recently, following the financial crisis in 2008, rates were cut dramatically from around 5% to 0.5%. And recently they've been cut again to to all-time record lows of just 0.25%. Now, these are the people who are responsible for deciding what the base rate of interest should be. They work for the Bank of England and they are known as the Monetary Policy Committee, or MPC. And they meet each month to decide what rate of interest set that would help to meet the government's target of 2% inflation as measured by CPI. And the data that they use to make this decision are some of the following. So they will look at the rate of GDP growth and the rate of spare capacity in the economy. They will look at the level of bank lending, consumer credit, so how much consumers are borrowing and how much retail sales are. They'll look at share prices and house prices to get a gauge of the wealth effect and how that's likely to influence spending. They will look at surveys of consumer confidence and business confidence. They will look at the growth in wages, average earnings, productivity, unit labour costs, and surveys on labour shortages and unemployment. They will look at unemployment data and the level of unfilled vacancies. They'll look at trends in foreign exchange markets and what's happening with the currency. And finally, they'll look at international data to look at the growth rates and potential demand for exports and imports by looking at the performance of economies of major trading partners such as the US and the Euro area. And based on all of this information, they will then decide whether they should raise interest rates, lower interest rates, or keep them the same in order to meet this inflation target. Now, the base rate of interest influences many of the interest rates in the economy, and there are lots of different interest rates. Bank loans have slightly different interest rates to mortgages, which will have slightly different interest rates to credit cards, payday loans, and other ways of borrowing or lending money. So, for example, a base rate of interest might be 0.25%, but a 2-year fixed rate mortgage might be 2%. What is important that we recognize is that the base rate of interest, whether that goes up or down, has an impact on these other ones within the economy. They tend to go up and down following what's happening to the base rate of interest. So the base rate of interest is really the key rate of interest, and then there are other rates of interest depending on what you're borrowing and how risky you're considered. But as this moves up and down, these tend to move up and down as well. So let's have a look at how changes in the interest rate can affect changes in the economy and get the government's inflation target to be met. The first one we're going to look at is through bank loans. So let's imagine a scenario here. Let's imagine that interest rates are going to be cut. Now, if interest rates are cut, that is going to affect the amount of borrowing. In particular, that's going to affect individuals who borrow. Individuals who borrow are going to take out credit cards perhaps, and also loans. And that in turn will affect their consumption. So here, if the interest rate is cut, we would expect the repayments on loans to be cheaper, the repayments on credit cards to be cheaper, and therefore there'll be more borrowing and more consumption. If we think also about the impact on businesses, if interest rates are cut, they're going to be taking out more new loans, which in turn should lead to more business investment. Their existing loans should become cheaper, which reduces their costs, which should increase their profit margins and increase employment. And this again should increase consumption and investment. So we can see here that a cut in interest rates over here should lead to an increase in consumption, an increase in investment, and these steps in between are how we would analyze this. This is how we would explain the relationship between interest rates and these changes in aggregate demand going down the route of the impact on bank loans. There is a second route that we can use to explain the impact of interest rates, and that's by considering the level of mortgages and savings. Let's imagine again that interest rates are being cut. How is that going to impact mortgages and savings? Well, in terms of mortgages, it's going to make existing mortgages cheaper, which is going to increase people's disposable income. They're going to be paying less in their mortgage each month. They'll have a bit more money left over to spend. Also, it's going to increase the value of houses. If interest rates are less and mortgages are cheaper, there's going to be increased demand for housing because it's relatively cheaper now to take out a mortgage. If there's increased demand for housing, this will drive up the value of houses and the value of what people own within their house, which we call property equity. That is the value of someone's house that they own themselves, i.e. subtracting away the value of the mortgage. So if property equity goes up, we would see a wealth effect, which would again increase levels of spending. So there is a direct relationship here between mortgages, interest rates, and consumption. A cut in interest rates will cut the cost of existing mortgages, driving up incomes. It will also make people more likely to buy houses, driving up the prices of property, and through the wealth effect, greater consumption. People will also more likely to take out new mortgages, which again would increase demand for new housing, which might lead to more investment. Let's also consider the impact on savings. If there is a cut in interest rates, savings is less attractive, so there's going to be more consumption. So again, here we have a relationship between interest rates on the left-hand side and consumption and investment on the right-hand side. And this time we can talk about the relationship in terms of mortgages and savings. As interest rates go down, consumption and investment go up. A final way in which we can talk about the relationship between interest rates and aggregate demand is through changes in the currency. So, interest rates can have an impact on exchange rates, and they can cause them to either appreciate or depreciate. And the theory behind this is known as hot money flows. The theory goes like this. If interest rates, let's say in the UK, rise and were higher than elsewhere, then people would want to put their money into savings accounts in the UK to benefit from that high rate of interest. They'd get a good return on their money. In order to do that, they would need to buy pounds. They would need to convert their money into pounds and deposit it in UK bank accounts. By doing that, by converting their money into pounds, they increase the demand for the pound and drive up the value of the pound. So often we see that as interest rates rise, there is an appreciation in the currency. It gets stronger. The flip side is as interest rates fall, we sometimes see a depreciation in the currency as the currency gets weaker. Now what we know, if there's an appreciation, spiced, strong pound makes imports cheap and exports dear. If the price of imports goes down, then the demand for imports will go up. If the price of exports goes up, then the demand for exports will go down. So here, a rise in interest rates would see a fall in the balance of trade, less exports and more imports. If, however, there was a depreciation because interest rates went down, we would see the opposite of spiced Whipperdeck, a weak pound, which makes imports more expensive, meaning we import less of them, and exports cheaper, meaning we export more. So here, this would have a positive effect on the balance of trade. So falling interest rates, weaker pound, positive impact on aggregate demand. So these changes in the balance of trade would ultimately have an effect on the balance of payments. So how do the government influence inflation? The main relationship we need to know is that if they raise interest rates, they do it to try and slow down the economy to bring inflation back towards target. If they cut interest rates, it's to try and speed up the economy, speed up the level of economic activity to get higher inflation to move it back towards target. And we describe these two approaches as expansionary and contractionary monetary policy. Expansionary monetary policy involves a cut in interest rates, trying to expand the amount of borrowing and spending, or increase the amount of exports through a depreciation of the exchange rate. Contractionary monetary policy is trying to bring down aggregate demand, reduce the level of inflation through higher interest rates on savings and loans, less loans being taken out, and making the pound stronger. So, if there is an expansionary, or what we sometimes call reflationary monetary policy, we would expect the following characteristics to occur within the economy. Cost of loans is reduced, which increases consumer confidence. Disposable income should rise. Business investment should be boosted. There should be a positive effect on the housing market, and the exchange rate should decrease with more exports. The flip side, if we see a contractionary or sometimes called deflationary monetary policy, we would expect the following: higher interest rates, which would increase the cost of borrowing, which would cause a slowdown in the housing market, a contraction in loans and credit cards, also an appreciation in the currency, so we might see less exports overseas as well. Now, we should be able to use diagrams to illustrate what's going on here. Let's imagine this scenario here, where currently we have a rate of inflation of 5%. So this rate of inflation is above target, and what the Bank of England would be required to do is they would need to raise interest rates, which would hopefully reduce aggregate demand and bring us back towards the inflation target of 2%. So we would illustrate that action like this. The increase in interest rates has caused AD to shift to the left to AD1 and has brought the price level back down to 2% inflation rate. If we imagine actually the economy was in this situation where the rate of inflation is 1.5% below target, the Bank of England may consider lowering the interest rate to try and encourage more aggregate demand to get back towards our 2% rate of inflation. So we've looked at what is meant by monetary policy, and we've looked at how interest rates are used in the UK. Let's finish off by evaluating the use of interest rates. So there are some limitations to interest rate setting and this effect that we've discussed so far. The first one is the MPC have to make a decision based on lots of data, but we might question how reliable that data is, the quality of it, and how much weighting each item of data should have. Secondly, the transmission mechanism that we went through, all those changes within the economy, typically take 2 years to fully play out. So the MPC have to ask themselves, right, what did we change 2 years ago? Has that effect been borne out in the economy? And if we change things now, we have to bear in mind it's going to take another 2 years for the full effects to be seen. Another question is, how large should the change in interest rates be? 1%, 0.5%. This is a judgment call by the MPC. Also, sometimes by reducing inflation, we also lead to a fall in economic growth. And so often there's a trade-off by meeting one objective, i.e. lower inflation, we might be sacrificing another objective, e.g. economic growth. A final problem the MPC find themselves with at the moment is, how do we stimulate the economy? How do we encourage more aggregate demand if interest rates are already at record lows like 0.25%? Can we cut them much further? And an interesting thing to consider is the existence of a negative interest rate. Would that be possible? Lastly, how much influence do interest rates have on businesses and households' decisions? Perhaps confidence in the economy is more important than purely just the level of interest. Another thing to consider is that when interest rates falls, there is a redistribution of income away from savers and lenders towards borrowers. So if the interest rate is low, it means the incomes of savers goes down, whilst the incomes of homeowners with mortgages, relatively speaking, goes up. So we might evaluate it by saying the impacts on different groups of people. And finally, are low interest rates helping the UK economy? Well, there are some arguments for and against that. Keeping interest rates low helps boost spending, and helps keep our exchange rate low. But on the flip side, there's can be some counter arguments that savers are hit very badly. That can be causing a boom in the housing market prices, and that there are other things that are causing low inflation that an interest rate can't help. So maybe worth taking a screenshot of this, printing it out, and sticking it in your notes. So in summary, we've looked at what is meant by monetary policy, and in particular in this video, we've looked at how interest rates are used in the UK and looked at some evaluation points on that. That's it. Thanks very much.